You've been sold a lie, a really expensive lie. The lie is this, that paying off your mortgage early is the ultimate financial goal, that being debt-free is automatically smart, that the day you own your house free and clear is the day you finally win. No. For a lot of people, that is the exact moment they lock themselves into middle-class financial mediocrity. Here's the brutal reality. If you rush to pay off a low-interest fixed mortgage, you are taking your best wealth-building tool, your cash flow, and trapping it inside drywall, inside kitchen cabinets, inside bathroom tile, inside a roof you cannot eat. That is not freedom. That is an invisible prison. Because home equity feels rich, but it spends broke. You can't use your baseboards to buy groceries. You can't swipe your front porch at the gas station. You can't sell one bathroom tile to cover a medical bill. And yet millions of people dump every extra dollar into their mortgage because it feels responsible. It sounds mature. It sounds safe. But wealthy people don't obsess over being debt-free. They obsess over being liquid. They obsess over control. They obsess over owning assets that produce income. That's the whole game. And this is where the middle class gets trapped. They think the goal is eliminate the payment. The wealthy think the goal is keep cheap money, buy more assets, and let the spread make me rich. That's why in the right context, low-rate fixed debt is not the enemy. It's leverage, it's optionality, it's time. And in inflationary environments, yeah, I said it, debt is safer. Not stupid debt, not credit card debt, not car note on top of car note debt. I'm talking about low-rate, fixed-rate mortgage debt attached to a real asset, while your extra cash goes into compounding investments. That's the part the average finance guru skips, because pay off your house early sounds emotionally clean. But build a liquid portfolio while the bank lends you cheap fixed money for 30 years sounds too sophisticated for bumper sticker advice. So today, I'm going to show you why the paid-off house fantasy can quietly keep you working until 65, why your brain is wired to make this mistake, and why the math, not your feelings, should decide this. Let's talk about why smart people make dumb money decisions. Because this is not really a math problem first. It's a psychology problem first. Your emotions see all debt as danger. Your brain hears the word mortgage and thinks monthly payment, obligation, risk, threat, make it stop. And that emotional panic is powerful. So what do people do? They throw every extra dollar at the house. Not because it's mathematically optimal, because they want relief. They want silence. They want the emotional comfort of saying, nobody owns me. And listen, I get it. That feeling is real. But comfort and wealth are not always the same thing. Sometimes the thing that calms you down is the exact thing that slows you down. This is where the middle class gets absolutely cooked by behavioral psychology. Because debt is visible. You see the payment every month. You feel it every month. It annoys you every month. But opportunity cost? That's invisible. The investment account you never built? Invisible. The compounding you never got? Invisible. The extra 6 figures you could have had 15 years later? Invisible. And human beings are terrible at respecting invisible losses. We obsess over visible pain and ignore hidden destruction. That's why people celebrate becoming debt-free while quietly destroying their long-term net worth. They're solving for anxiety, not optimization. Another problem, certainty addiction. If you pay down a 4% mortgage, you get a guaranteed 4% return on that extra principal. Clean, predictable, no drama. If you invest in the stock market, Returns are volatile. Some years are ugly. Some years are incredible. That uncertainty scares people. So they choose the guaranteed 4% because their nervous system loves certainty. But what their nervous system calls safe, their future self may call expensive. Because over long periods, the stock market has historically returned much more than a low-rate mortgage costs, and that spread matters a lot. So when someone says, "I know investing might earn more, but I just want peace of mind," what they're really saying is, "I'm willing to pay a massive long-term price to stop the emotional discomfort I feel today." That is a luxury decision, not a math decision. And if you keep making financial decisions to stop panic instead of build power, you stay stuck in the same cycle. Work, pay bills, celebrate debt reduction, build very little liquidity, retire late, hope the house saves you. That's not freedom. That's a prettier version of being trapped. Your brain is broke. Not because you're dumb, because it was trained to worship debt freedom more than wealth freedom. And those are not the same thing. Okay, now let's leave feelings out of it, because the math is brutal. Let's compare two people. Same house, same income, same mortgage, same discipline. Only difference is what they do with an extra $1,000 every month. We'll use a simple example. 30-year fixed mortgage, $400,000 balance, 4% interest rate. Person A takes that extra $1,000 every month and sends it straight to the mortgage. Person B takes that same $1,000 and invests it every month into a low-cost S&P 500 index fund. And when I say invest it, I mean automate it. No stock picking, no meme coins, no fake guru nonsense. Just disciplined monthly investing. Now, let's fast forward 15 years. Person A, the early payoff hero, has been aggressively attacking the mortgage. After 15 years of those extra principal payments, they've reduced their mortgage balance by about $246,000 more than they would have on the normal schedule. That sounds amazing, and emotionally, it feels amazing. They look at the house and think, "See, I'm winning." But hold on. Person B invested that same $1,000 instead. At 8% annual returns, that account grows to roughly $346,000. At 9%, it grows to about $378,000. At 10%, it grows to around $414,000. Now compare the outcomes. Person A, the early payoff hero, improved their net worth by reducing debt an extra $246,000. Person B improved their net worth by building a liquid portfolio worth somewhere between $346,000 and $414,000. So even after accounting for the bigger mortgage balance, Person B is ahead by roughly about $100,000 at 8% returns, about $132,000 at 9% returns, about $168,000 at 10% returns. That is the brutal math. And remember, Person B didn't just build more net worth. They built liquid net worth. That matters, because liquidity is what gives you options. If Person A loses their job, what do they have? A lot of trapped equity. Cool. Can trapped equity make the mortgage payment next month? Not without a refinance, a HELOC, or selling the house. And good luck doing that when the market is ugly, rates are high, or banks tighten lending. Person B? They have a real portfolio, a shadow portfolio, a pile of actual, movable, sellable, income-producing assets. That portfolio can cover emergencies. That portfolio can throw off dividends. That portfolio can be tapped strategically. That portfolio is freedom. Home equity is not useless. Let me be clear. Home equity is fine. But it is not the same as liquidity. It is not the same as optionality. It is not the same as financial power. And here's the insult. The bank already gave you cheap money. They gave you 30 years. They gave you fixed terms. They gave you predictable payments. And instead of taking advantage of that cheap long-term capital to build assets, you ran back and returned the money early. That's like getting a low-cost business loan and using all your profits to kill the loan before you ever build the business. It feels responsible, but it shrinks the upside. That's why wealthy people don't rush to destroy cheap leverage. They keep cheap leverage, and they put their cash where it compounds faster. That spread is where wealth is built, not in the emotional high of making the bank statement smaller. Now let's talk about the cheat code nobody explains properly: inflation. Inflation is one of the biggest reasons fixed mortgage debt can actually become safer over time. Here's why. Inflation quietly destroys the value of money. Every year, your dollar buys less. That's bad when you're holding cash, but it's incredible when you owe fixed-rate debt, because your mortgage payment does not rise with inflation. Your payment is frozen. Same nominal number, year after year. Meanwhile, your wages usually rise over time. Prices rise over time. Asset prices tend to rise over time. But your fixed mortgage payment? Still sitting there like it's trapped in the past. That means every year you are paying the bank back with cheaper dollars, less powerful dollars, more inflated dollars. So who gets hurt by inflation in that relationship? The lender, not you. If inflation averages 3% over 30 years, the real burden of a fixed payment gets crushed. A $2,000 mortgage payment in year 1 has the purchasing power equivalent of only about $824 in today's dollars by year 30. Read that again. Same payment, way less pain. So when people obsess over eliminating a 3% or 4% fixed mortgage early, they are ignoring one of the most beautiful wealth mechanics in the system. Inflation is helping them. The debt is getting lighter in real terms all by itself. And if your cash is instead being invested into productive assets, businesses, stocks, index funds, those assets have a chance to grow while your debt quietly gets easier to carry. This is why I keep saying, in the right setup, debt is safer. Because the risk is not just having debt. The real risk is misallocating capital. The real risk is locking your money into illiquid equity while inflation is actively reducing the real cost of your fixed loan. The real risk is spending 15 years trying to feel safe while your money misses its best compounding years. Again, this does not apply to toxic debt. Credit cards at 24%? Kill that. Personal loans for nonsense? Kill that. Adjustable rate debt you can't control? Dangerous. But a low-rate fixed mortgage on a house you can comfortably afford? That is not automatically an emergency. That can be a strategic tool, and middle-class people are trained to treat strategic tools like threats. That's why they stay middle class. So what should you actually do? Simple. Stop worshiping the paid-off house fantasy like it's the only path to freedom. Build a shadow portfolio instead. Here's the play. If you have a manageable, fixed-rate, low-interest mortgage, and you already have your financial basics handled, stop making huge extra principal payments just to feel emotionally clean. Redirect that extra cash. Build liquidity. Build assets. Build ownership in businesses through low-cost index funds. Build a portfolio that can grow while you sleep. That is your shadow portfolio. Why do I call it that? Because while everyone is staring at the house, you're quietly building the real thing behind the scenes, the thing that can actually replace your income, the thing that can absorb emergencies, the thing that gives you freedom before retirement age. Real wealth is not, I have no mortgage. Real wealth is, my assets can cover my life. That is a completely different game. And here's the beautiful part. Once your shadow portfolio gets big enough, you earn the right to choose. You can keep investing. You can pay off the mortgage in one shot if you want. You can semi-retire. You can downshift your career. You can take a risk. You can buy back your time. That is wealth without burnout. A paid-off house with no liquid assets? That can still leave you fragile. A healthy fixed mortgage plus a massive investment portfolio? Now you're dangerous. Now you have options. Now you're playing offense. So if this hit you like a reality check, good. That means you're starting to see the trap. The goal was never to die with a paid-off house and a tiny brokerage account. The goal was to become impossible to stress financially. And that comes from assets, not just absence of debt. So here's your move. Keep the cheap fixed mortgage. Respect debt, but stop panicking over good debt. Build your emergency fund. Automate the investing. Grow the shadow portfolio. And let the math do what your emotions never will. If you want more videos that expose middle-class money traps, break down the brutal math, and show you how wealth actually works, hit subscribe. And in the comments, tell me this. Were you taught to pay off the house early, or were you taught to build assets first? Because that one belief might decide whether you retire free or just exhausted.